All right. I'm curious to see how many people logged in on at 1 instead last week instead of 12 Pacific time. We forgot to, I think we forgot to change that one.
Yeah.
1 second, guys. All right. Dante, where are you heading to?
Mililani.
Milani? Oh, okay.
Yeah, I just got a closing, so I'm taking all my stuff right now.
Yeah? Oh,
Yeah.
Congrats. What is that? Like, is that a sale?
Yeah.
Yeah. All right. Okay, we'll give it some time to let people log in.
Did you guys change the time to like 9 o'clock?
No, it's the same time in Hawaii, but since we have daylight savings and we don't change, right? Like now we're an hour earlier on the mainland. So
okay.
yeah, we're going off Hawaii time.
That's one thing good about white time. Our time don't change. So
Yeah, it doesn't change.
That sounds nice.
All right. Oh, I see Daniel over there. Where are you guys going? Site visit. What's up, guys? All right. Mitch, were you able to choose a CPA and attorney to kind of lean on yet?
He's still working through the process. Trying to get your guy to follow up. Yeah, he's ghosted me twice so far. So not the best part, but maybe he's got Thanksgiving on the mind. He's trying to secure a turkey or something, which everybody should start thinking about, because I've heard that turkeys are in short supply. So I'm gonna try and get mine, maybe even today. Anybody else ready for Thanksgiving?
Sorry, guys. I think I lost. Sorry, Mitch. 1 second.
Is the audio scratchy for everyone or just me?
Aiden, are you on?
You're a little scratchy for somebody.
Okay, I think I'm back.
Yeah, we can hear you now, Corey.
Okay, perfect.
No
Thank
more
you.
weird sound, background sound.
Oh, it was? Okay.
Yeah.
Thank you. Sorry, Mitch. I missed the last part of what you said. Can you repeat that?
I wasn't able to get in touch with him. Although I did sit down and have a consult with another accountant. But yeah, I'm still not entirely sold on it. So I'm definitely going to keep looking.
Gotcha. All right.
Yeah. But thanks for the tip. I'm still waiting to talk to the guy that you recommended.
You're on
Let me
mute.
know if
I cannot hear you
in
there.
touch.
You were muted.
All right, guys. Well, why don't we jump right into it? I know there's people still jumping in. And Kekoa is running a little bit behind, but he'll be on soon. So hopefully everybody had a great week. And it's a happy Aloha Friday. I thought it was Fancy Friday today, but I was the only one that dressed kind of fancy. Well, why don't we jump right into it? Leads, needs, and good deeds. Does anybody have anything? Kione, how's it, bro? You guys looking at deals?
Yes, sir. Always and always, man.
All right. What is it? Is it because I know you guys are going after some or you've been going after some buy and holds too here for what is that? Short-term vacation rental?
Yep, exactly. In escrow at a bunch right now. Just dealing with some tenant stuff.
Oh yeah. What happened with the tenant?
Couple of them are pushing it off, and I feel bad. It's like I don't normally take on houses, especially for flips with tenants, and I have too much of a soft heart. And especially with the holidays coming up, I'm a sucker for it. So I have like 3 right now that I just got notified yesterday that I'm also extending another one. And I'm just trying to solidify and put in paperwork now, trying to draft something up so the needle doesn't keep moving. But they're pushing it. I was like, okay, cool. Hey, Thanksgiving, but I don't want it to be friggin' Christmas, New Year's, and like, oh, so yeah.
Right.
One of those things I'm dealing with. Yeah, I'm not a familiar guy to doing with tenants. So I'm kind of a rookie when it comes to that. I've done a bunch of houses, but it's probably one of the reasons why I don't like taking on tenants.
Right. Yep. Well, how you
So,
doing, Richie? I see you. You
I
guys need
wanted
anything?
to,
Oh, Tay, go ahead, Tay.
sorry, quick. I wanted to get your guys' opinion. So on Maui, there's a lot of talk of short-term rentals being terminated, and it sounds like, and I don't know if Mike Neubauer's on, but it sounds like the county or the community is going after the county and kind of just trying to put some kind of like better criteria, it sounds like. But there was almost a talk of like just canceling everyone's STR permits. Or it's got to be in a specific zoning and such. So a lot of STR owners right now, I guess they don't want to deal with it, especially out of state. So they're trying to liquidate their STRs here on Maui. And I mean, we're getting a lot of leads on those, but they're trying to make their money, and they're trying to sell it almost like how when they bought it. And when they bought it, it was with the intention of STR. So they were analyzing their deals with, a $6,000 to $10,000 monthly income. But anyway, they're trying to sell it at with that in mind still. And I think they're hoping that buyers are not catching on. But selling for really high, and just wanting a bit of feedback. Like if I look at comps, it works. Like someone is trying to sell something to us for a deep discount compared to what like the comparables are selling. I kind of almost want it, but should I analyze strictly with a long-term rental, like a buy and hold, or should I analyze with a quick fix and flip? Because they're still selling, high. Like if I look at ARV with current comps, literally it works. So just wanting everyone's feedback on that.
That's interesting. So maybe a couple questions. First, do you feel the community is for or against short-term vacation rentals over there?
The newspaper just literally had they shared how the community and how STR owners are feeling, and it's almost like an even split. It's like a 47 to 53%. Community is kind of against it, but it sounds like they're against the SFH being short-term rental, not we're getting a lot of leads in the condos right now. But yeah, we just don't know, because the county it keeps on having meetings about it. They just haven't made up their mind yet. I can't even tell where they're leaning, what they're leaning towards.
I think that's, and I have people who are looking to get into Airbnb here, And I'm like, it's just a volatile time. So you need to just make sure you have more than one exit strategy if you're going to take those down. And it's very possible, that the short-term rental market is going to be affected. And if that, decision doesn't make sense with long-term or on resale and you're buying high, the market's already inflated. They're selling at the inflated price based off of, a cap that's probably unsustainable, potentially. I think just proceed with caution. Don't get too excited because there's a flood of them. If there's enough of them and then they start to devalue, that's what I would look at. But I would wait until the values are a bit lower, or you can negotiate those down, or find just the few that are sitting for a while and just get them down as low as you can. So at the end of the day, you could ultimately still resell for around what a market shift might be at 5% below. So look at the area, the historic, inflation and deflation rates of that market area and see, okay, in 2000, for Hawaii, it was 2010, 2011, we saw our market crash, right? Versus mainland, and say, okay, what did the prices drop down to? What percentage? Like, Kailua and on Oahu dropped maybe 3 to 5%, but Wahila and Waianae, they dropped as low as 11 to 15%. So look at the historic, neighborhoods, what those devalued at, and then just make sure that you buy with that in mind. If it devalues at that, what did you get it for? And can you resell it and get out?
Okay. Yes. Yeah. Awesome. Thank you.
I have something I want to share. So I went to a conference for EXP, but I met this guy. His name's Will Gardner, and he's a developer. He's not like a big investor. He pretty much just develops for himself and invests, but he's a connector. He goes to Pitbull and NP, like other things for lending. And so he's creating an app. And essentially the app is for wholesalers and for people who are good at finding deals and they want to put it on a platform. And on the app, it'll have what they're wholesaling it for, what they estimate the ARV to be, and then what their fee will be. And so obviously the only way that something like this is successful is if a lot of people are using it. And I was like, well, we have a great family here that I think would be a great plug to at least use as a resource. It would be national. So it would be all markets. And most of you guys invest in all markets or open to it. And I was thinking of asking Keiko and Corey if they wanted to have him on, but I'll put his name in the chat and get the name of the app. It's going live this year. And, download it, log into it, see if you can find any deals off of it, put some deals that you find on it, and let's get the app huge and use it as a leverage opportunity for you guys.
Cool.
Thanks, Ashley. It was good seeing you in Vegas.
It was too short. We didn't see each other long enough. So we're gonna have to come to Cabo in March.
Nice. I'm looking for the text with the invite and I didn't get one. So I'll wait for
Right now.
Anybody got anything else that they want to share? Anything going on? Deals to share? Anybody got money? Greg got debt. How's Maui?
What's up, man? It's good. I'm glad to finally be here. I haven't been able to make it the last few weeks, but we got a closing today. Really excited. We finally recorded on this thing. Probably best deal I think I've ever done. Purchase price 640. What was it? 655. Rehab was about 20 grand, and sales price was 945. So it's just super. Yeah, the market, it's all thanks to the market, really. I can't really take credit for it. Yeah, prices just happened to increase dramatically at the perfect time when we were already under contract, and worked out. But anyways, I have a wholesale deal in Waiahu. I don't think I've mentioned this one before. Because I just decided we're going to wholesale it in the last week or so. So it's a 3-unit, can be used as a rental, but probably better as a flip. And it's 800,000 or 820. What is it? 829, 830,000. and it needs about. It's hard for me to estimate, but the estimates people we've talked to estimates we've gotten about probably 150 in rehab, and the closest comp is sold for 1.25, and it doesn't have a pool. So I think it's a little bit probably ARV is going to be around 1.2 to 1.3 at least, maybe a little higher. So shoot me an email if you're interested.
It's a nice property. I wish it would be a short-term rental eligible because that'd be perfect, but.
Oh, that's right. Yeah, we talked about it.
Yeah, well, I emailed you. That's a deal. 300,000 in Maui with a view. That's a good deal.
Oh, the view of that property, yeah. Which
Yeah. Well, if you can't get a place and we can do a joint venture for 700, let's do it.
What's that?
You can't get it placed and we can do a JV at 700. Let's do it.
Yes, Helena.
Oh man, if we could get a 700.
I know, right?
Super stoked. Yeah.
Awesome. So if anybody's interested in that deal, it's a pretty nice one. Hit up Greg. Greg, throw your email address in the chat, bro.
Just did.
Maui Home Buyers. Sweet. Anybody got anything else? Otherwise, we're going to move on to our special guest today.
I wanted to ask.
Sure. Who's that? Breeze? You got to unmute if you could. If anybody could read lips, that would be helpful, but otherwise, I don't know what you're saying. Hey, Breeze, do you know how to unmute yourself?
I want to ask if it's possible to sell something with a maintenance fee, a 2-bedroom condo, and get something that doesn't have a maintenance fee, or do I have to go to the Big Island for that?
Ashley, can you do that question in terms of what areas don't have maintenance fees? Hey, Breeze, what is your, do you have an email address?
Yeah, spirit.breez.
Ashley, do you want to hit her up individually? Say it one more time, Breeze.
Spirit.
Spirit.
Dot.
BREEZ.
Sweet. Spirit.breeze.com.
At Yahoo.
At Yahoo. Perfect. Ashley's going to email you. She is our resident Hawaii real estate expert. So she'll give you some information about which buildings can you get away from all those fees.
Okay, thank you.
Yeah, you're welcome. Anybody else got great questions like that? Those are easy ones.
I got something. So I'm working on trying to get a property off market in Pearl City.
Giovanni, you look like you're working on a squat is what you're looking like.
Yeah, actually, I just finished squats and now I'm on the deadlifts. Yeah.
Love it.
Yeah, 355 for 7 on squats and then 455 on deadlifts for 4. So getting ready for a competition in March.
Nice going, bro. All right, on. All right. So what now you you wanted to say something else besides working out?
Yeah. So I got a property I'm working on. I found out who the actual owners is.
Okay.
Thanks to the help of Corey, I got their number. I left a message.
Okay.
I know where they live, but just wondering like what would be a good approach to like send an email and then kind of like go and door knock and kind of introduce myself and let them know I'm interested in their property without being too salesy.
Yeah, that's a great question. You know who I'm gonna have answer that? Greg, are you available? Greg does this every day.
Oh man. Well, first, just disclosure, I might, I'm not sure if I might just cut out a little bit in the next like 5 minutes or so, but I mean, yeah, there's a million different, I think, strategies like in terms of like how to structure that, but personally, I would just go to, I mean, I think you said you already have their address, but I'd pull their info from the property tax records and then just skip trace them, use any one of a million skip tracing services to get their phone numbers. If you want to call them up, shoot them a text, send them a letter. I probably kind of do a little bit of a combination of all those things, depending on how hot of a lead it is. Some of them, I just add them into our direct mail funnel and never think about them again. Other ones, if I have reason to believe that they're really hot and like they actually want to sell or they're motivated or whatever, those are the ones where I'm going to be like sending them mail, maybe even personally, like I will handwrite them a letter if I really want it. And then I'll also, door knocking, you mentioned, just go over there, show up and just, I know what you mean by like not wanting to be too salesy, but don't overcorrect with that. Like I'm the same way. I don't want to come off as like only thinking about me and, we're only here to make money sort of thing. But the reality is it's a business, I think it's good to be aware of that, but don't take it too much and just go and approach them and let them know, hey, if you're interested in selling and you don't want to deal with the headaches, the repairs, the cleaning, the staging, all the things, the showings of listing, we have an alternative for you. And I wouldn't worry too much about the salesmanship part personally. I don't know if any of that was helpful.
No, that's good.
It definitely was. Yeah. Thank you. Yeah.
Do that every day. Yeah, Javon, we just sent a letter to a seller in Vegas. We sent it and she received it on a Monday. And then on Tuesday, we door knocked her and just was super casual, just said hi, just had a conversation about the possibility of selling. And she actually was so comfortable. She invited inside to sit down at the dining table. So you just got to take it a step at a time and try to see what their needs are. You start with their needs as opposed to your need and see if you can just start a good conversation. Don't try to close them on the first time is kind of what I've learned over the years. More just build a relationship. We bought wholesale deals from people we approached, a year and a half earlier. So it takes some time sometimes, but they'll always remember if they feel like they could trust you, if they like you, and if they feel they want to do business with you. Those are the keys, and just be patient. And the more doors you knock, the more people you contact, the more deals you'll have. But it's really about planting seeds today. And then over time, that harvest will come and you'll start having a lot of good people call you back.
I have one thing to add. Since you mentioned again, not wanting to come across too salesy. One of the things, my personal, I'm just, whatever, it's not a secret anymore. But one of the things that I try to do is when I talk to a seller, if they call me, whatever the situation is, I always try to let them know, like, hey, if you're interested in selling and you like me and I like you, we have comparable values or whatever is important to you, then great. But if you're not, or if you decide that listing with a realtor is the right option for you, or whatever the case is, or if you decide, let's refinance or whatever you need to do, whatever your solution is, I'm here to help with that, whether it involves us, buying a property and making a profit or not. So I'm not here to make a profit. I'm here to grow my business. And I do that by helping the community. And so that's kind of my own personal pitch. And I truly care, like I want to help people. And I also truly believe that by helping people and by trying to be selfless, when I'm meeting with sellers, ultimately, if that person ends up making the right decision and maybe I help them find the right realtor or mortgage broker to refi, whatever the case, that's going to lead to them being, having a really good experience with me and promoting us to others and helping our business grow long-term. So that's kind of my own sales pitch.
Love it. It's good stuff.
Awesome. Thank you.
All right, Javon, we want to go see that squat, man. 700 to do it.
And Javon, Aiden dropped something in the chat. He said he can help you at skip tracing if you need, and anyone else on the call. So feel free to reach out to him. Thanks, Aiden.
Awesome. Thank you.
Yeah, no problem. Just I'll just put my number in there. You can just text me the address, or if you know their name, I can get the contact info for you.
Oh yeah, you already did. Yeah, you did that for me.
Oh, did I?
Yeah. Yeah, so I have their address and their number. So I was thinking about going up to their home and bringing some really good poi donuts and just introducing myself. So. Oh
yeah, right, the monopool box or something. That's the way.
That's the way. Drop some off by our office too, Javon.
Please.
Yeah.
Aiden's so good. He didn't even know he got it done already, man. You're on it.
I love it. Pretty much.
I love it. That's fantastic.
Guys, I just want to say Aiden just turned 21 yesterday, and he's a stud. So happy belated birthday, bro. And he's gonna be making some big waves, soon. So reach out to him if you need help too.
Thanks, Uncle Corey. Appreciate it.
Uncle Corey. Hey, tell Uncle Corey to bring you to Vegas next week so that way we can go out and celebrate.
Look at this guy. He just turned 21.
Cool.
Hey,
Let's go.
21 is 21's all you need, man. That's all good stuff. Well, right on. Hey, everybody, let's if you got anything else posted in the chat, want to just jump in with our special guest today. Unless Corey, you got anything else to share?
No, Lily just asked for a referral for an attorney. So we can help her out with that. Maybe Lily, if you can reach out to me, I can try to see who would be a best fit for you if you need an attorney. Yeah, that's unfortunate. Her attorney's telling her that don't work with wholesalers because they are illegal. I can't believe. Yeah, you go. We're gonna find you a new one.
Yeah. If you got an attorney recommendation, drop it in there. Otherwise, Corey and I can give you ours, but ours is extremely expensive. But
yeah, it matters who you like. It depends on what you need. If you need an attorney to just look over and review or draft documents, then we have, we can refer you there. It just depends what type of attorney you're looking for. So we can sidebar if needed. But thank you guys. Okay, cool. Yeah, let's bring our guest on, Austin.
Yeah.
I've been looking forward to this one.
This is, I know this is going to be good. So Austin is our guest today, and Corey literally has been talking to me about the stuff that Austin's about to talk about for, probably like 5 years. He's like, we need to do this. We got to get some money here. We got to do this. And when I met Austin, I'm like, dude, I've already been hearing about this through my partner. So Austin's awesome. He is a graduate of the University of Washington, co-founder of their advisement firm, financial planning, financial advisement, Guide Advisors based in Washington. Family guy, married with a plethora of children. I think it's 3, right? I think
we
it's 4.
have 4 kids. Yeah.
4. Yeah. So that's why you go to church, is you got to pray every weekend for all those kids, man.
Dude, seriously. Yeah. Also for my sanity, right? That's
yeah, 100%. And Austin is awesome. I work with him personally, and we do a lot of stuff together. And more than anything, he's just got a great heart. He's sincere, and he's really good at what he does. And today he's going to share some insights just about his business, but then also what they do relative to financial planning. And a lot of these tricks and I don't know to call them tricks, but strategies are really, really helpful for those of us who are real estate investors, especially as we're looking to scale, but then yet also plan for the future, plan for retirement. These are all opportunities for us to take advantage of now. So it's not something we have to do later. So with that, Austin Dean, welcome to Coffee Talk on this Aloha Friday.
Thank you for having me. It's good to be here.
Yeah, like it's such a good Aloha Friday that even it's sunny behind you, which is in Redmond, Washington, which is a miracle by itself.
Although it's a little cold.
Dude, it's super cold. So Austin, tell us a little bit about what you do. Tell us a little about the company that you co-founded, just a little bit of background on who you are and what you do.
Yeah, absolutely. Yeah. And hearing you be like advising a financial advisor, financial planner, it is interesting because having worked with real estate investors for so long, the term financial advisor, financial planner is almost like distasteful because most people that have that hat don't like real estate or don't know how it works. I can't tell you how often I get connected to new clients and they call me like the wealth guru or this morning, literally, one of my real estate clients I've worked with for years, he introduced me as his financial wizard. And I was like, let's go for it. But just, yeah, so some background. So I've been in the financial planning, wealth building world for about, a decade now. You can tell I'm pretty young. When I got into it, pretty much right out of college, I went into it because I love the ability to partner with people, help figure out what are their long-term goals, what's their vision. And how do we align their resources to go with that? I wasn't a huge fan of the traditional financial model of stick all your money into 401ks that you can't touch till you're 60. I was like, how do we design wealth to be more flexible so people can build businesses, change lives, and be financially independent and financially free before they're 60 if they want to. And I wanted that one for me, like I wanted that, but also I thought there's a lot of category, particularly people here that aren't trying to just work a day job till they're 60. You always want to do important things, and I find that as often as not, it's a combination of how do we create financial independence, but then how do we create a legacy for kids and family and charity. So that gets me pretty hyped. And it was, I think, 9 years ago, I had my first real estate investor client. He was late 20s. He came to me and said, hey, I got 5 single family properties, cash flowing. I love this. I need a financial planner to help me with getting the right people on my team, structure, and how to manage taxes. Should I do life insurance? Should I do investment accounts? And how do these play in with my goals? But I don't want somebody telling me to stick my money into all 401ks. And that gave me permission to start getting creative. So from then on, that's how I started looking and figuring out, okay, how does life insurance work? How can we do investment accounts, but have it still be available for real estate? What does it look like to do private lending? And what's the pros and cons of REITs and DSTs and all these different things that can be a good partnership to a well-rounded financial plan. So after doing that, like I then, so Keiko, have you had Tyler Curley on this before?
We haven't yet, so don't say that too loud. We'll eventually have one.
I won't ruin it. But either way,
we wanted you first. We needed the guru first.
That's fair. So it's over time, I found great people like Keiko and other people that worked with real estate investors. We started essentially this group and community of trying to help people create financial independence. And now, as of last year, I did a merger with another financial planning firm. We rebranded to be Guide Advisors because we want to be a group that is coming alongside people, like I said, aligning their finances and helping empower them to be able to create that financial freedom, financial independence that they want to be doing. We have, I think, 13 people on our team now, which is crazy to think. It was 10 years, it was just me. Now we got 13. We're expanding. Awesome. Our newest advisor is actually on this call. It's Pete Mathias. He's a longtime client, also a real estate investor, owns properties in OKC and Kansas City. And I invited him to join the team because I was running out of capacity to be able to help all the people that I wanted to help. So it's, so here we are. And it's, there are quite a few unique things that I do to ideally help people, particularly in that real estate space, have their money do more than one thing at the same time. Right.
That's awesome. Welcome, Pete, as well. Glad you're with us. Are you in OKC?
No, I'm based up here in the Seattle area as well. But
gotcha.
Got properties in a few different
places. Close to you, Keiko, in the Issaquah area. So
yeah.
Nice.
Yeah.
Dude, I feel like I know you from somewhere. So we'll talk about it.
I've been to many of Tarl's meetings in the past.
That's why. Okay. I'm like, I recognize that guy.
Like I said, I was a real estate investor before I moved into this space.
So you're a recovering real estate investor. That's awesome. Well, welcome. And I'm sure we'll run into you over here a little bit more.
Sure.
So Austin, that's fantastic. Corey and I are just going to kind of ask you some questions. And then if anybody's got questions for Austin, drop in the chat. Why don't we start? Actually, Corey, I'll let you start because you've been salivating over today's topic for, gosh, as long as I've ever known you. So I know all about what Austin does, and we've had long, extensive conversations, Austin and I, on how to help our clients. We have now mutual clients. And so, there's so much that Austin can do and unpack. So Corey, take it away.
Well, as much as I'd love to be selfish and talk about just the strategy that I want to pick Austin's brain about, where do we start? I guess.
Yeah.
I mean, Austin, I know we have there's a few products and strategies I think that we're exchanging through emails and stuff. So why don't we go through like maybe the top 3 or 4 that you have in mind that could benefit people on the call, and then I'll probably get into it as we go and ask the questions that I wanted to ask. But what would you say, like, of the 4 kind of what do you call them, strategies or strategies?
So I'd almost put it in 2 categories. There's almost like the first tip is creating a framework for where should my money be going? What kind of assets should it be creating, right? So thinking about, there's short-term money, which is money that's you stick in the bank that's doing nothing for you in exchange for having accessibility and ideally no risk of having to go away, right? Then there's traditionally in the traditional model, non-real estate space, we're taught to then pump a bunch of money into our retirement accounts that we can't touch till we're 60. As you guys can imagine, and as I know we've all experienced, that creates the downside of that money's doing literally one thing for you, and the IRS is in exchange, they're saying, hey, we'll give you some very basic tax benefits if you put your money in money jail, right? So if we look at those two categories, money that's safe but doing nothing, money that is doing something that you can't touch, neither of those are really very attractive for creating financial independence before you're 60.
Right.
So that's where creating a framework of, okay, what are those assets in that, what I call that midterm category, money that you can access without penalties whenever you want to, that are actually doing something for you, right? So that typically falls into one of two categories. There's taxable investment accounts. So investment accounts that are non-retirement based, meaning you can access it whenever you want to for whatever you want. And then there are certain ways to use life insurance policies that actually, and we can talk about this a little bit more, but there are ways to build money tax-free inside of those that have a portion of that money actually has contractually guaranteed growth, consistency. And you can actually create a bank account that's kicking off 5% with the risk of cash that you can pull money in and out of for real estate investing, lending, whatever you want to do.
Hey, Austin, can I add to what Corey said? And why don't we do this?
Yeah.
Pretend that we're a brand new client, because I'm going to kind of profile a lot of us that are on this call today. A brand new client coming to you. We're real estate investors. So maybe we flip a house here and there. Others of us, maybe in our portfolio, we hold a couple of properties here and there. So we've got some portfolio. Our cash is largely a cash flow type thing. Like we got money coming in through construction, we got them going out, we flip houses. So there's money flowing, but we don't necessarily have a huge savings account, but we got some money. We know we want to save towards retirement, education, children, that type of thing. And we kind of just haven't really spent a lot of time thinking about it yet. If we're brand new kind of to your space and we're coming to you, the guru, the Wizard of Oz, and we're saying, hey, help us. What's the first thing that we should think about doing as active investors, trying to get tax benefits, but at the same time, trying to save for the future, but kind of every penny we got right now is going into our real estate investing business. How does that help? Does that help you kind of give a profile of how to help us?
I think it does. I mean, so if it's every penny's going into real estate, I would almost say the first thing is, do you have some sort of like emergency reserve kind of bucket for the what ifs? Because we all know that real estate's been amazing the last decade, but what happens when a flip goes poorly or there's some sort of regression there? And ideally, if we can put that money, our emergency reserve money, in something that's not just a bank account, that's where those midterm assets come to play. And I could potentially bust out the whiteboard and draw some stuff if that'd be helpful.
Draw some stuff, bro. I like it. We got you and a bunch of us. I think that if we were to be honest, we haven't given a lot of time to just kind of planning. So yeah, help us. So, and let's say not every penny's going in. We've got some money here and there. Let's say we've got between 25 and 100K kind of sitting around here and there. It kind of goes ups and downs. And some of us, when we're brand new real estate investors, our net worth is basically our checking account balance. We're like, okay, yay, we got $10. We could go out. Other months we're like, oh, we got 400 grand. This is great. But it's kind of vacillating. If we were to get intentional about utilizing some of these, what you call midterm, that just has a really bad reaction when you say midterms from school days. But
I hadn't thought of that before. That's so funny.
But yeah, how's that?
Gotta be studying. Yeah, let's do that. So I apologize for you drawing on my screen. It's this is why I talk while I do it, because you can't always tell what the words are. So here we are. That's
nice.
Yeah. But what we're just saying. So I like to kind of to draw that picture and kind of say, okay, if we have that short-term money, which is the money that's really our cash, right? If we have our midterm bucket, long-term, and quite literally, I mean, long-term is the 59 and a half. Your 401ks, your IRAs, things that literally it's money jail. The IRS says, hey, we're gonna give you some benefits, but you can't touch it before then. If you have enough money in this cash section to have really 0 to 3 months of savings, or I mean, for people that are more sophisticated at managing their debt, I mean, honestly, having 1 month there, but having lines of credit that are there whenever you need it to be able to pull into your system allows you to be more flexible. But if you have it, if you have income and you're not getting free money in this space, and you have whatever you need for short-term goals here, you really need to be pumping money into that middle bucket, those midterms. Okay, go. Yeah.
Love it.
Right. Which is those taxable investment accounts. This is money that's invested, I mean, in the stock market, stocks, bonds, those kinds of things. And certainly there's ways to do that better and worse. And there's actually academic Nobel Prize winning research around it, but like that's a different conversation. And then there's the cash values of life insurance, which whole life is really the best one when working with real estate, which we'll talk about in a second. But for me and the clients I work with, we pump money into this bucket, and then you can do withdrawals, but generally you're going to want to be able to, and I'll explain this in a second, get lines of credit that you can pull on to be putting into those real estate spaces so that you're having money that's being made in here while you're still using that money and putting it into real estate, having to do more than one thing.
So to say it again, so you're putting, so you got short-term money, groceries, cash, that type of thing, and some real estate, moving flips, etc. Got a little bit of extra money. We're dumping it into this bucket in the middle called a midterm. Yep. And these are monies we're putting in that are essentially a tax shelter. Is that right? Well, at the same time, also something that you can utilize with a line of credit.
Yeah. The life insurance is a tax shelter. The taxable investment account isn't technically a tax shelter, but if you pull out money from it via line of credit, it's functionally a tax-free transaction, kind of like doing a cash out refinance in a home. You don't pay taxes on that, right?
Gotcha. And then the amount that you put in on a monthly basis is variable?
Yeah, I mean, it's pretty much whatever you want. So using structurally, I have some life insurance policies that I designed at kind of fixed ceilings that I pump money into every year, and that I increase my lines of credit when I add money to that. And then when I have surplus above and beyond that, I add it to my taxable investment accounts, which then allows me to increase lines of credit on that. And then I can use them together. So let me explain a little bit of those things and to kind of oversimplify it. If we have that taxable investment account, for instance, and let's say we're pumping money into this, we expect this account to be getting, I don't know, anywhere from 5 to 10% over time, depending on what the market does and how risky we want to be with it. This is where, and there's two different types we'll talk about here. So there's what's called a securities-backed line of credit, which is a line of credit backed by your investment account. And there's what's called an insurance-backed line of credit, which is a line of credit backed by the cash values of your life insurance policy, which not every life insurance policy works for this, because there are some that are more aggressive than others. But securities-backed line of credit, here we go. So generally, depending on the risk, we can have access to 50 to 70% of this total balance. And currently, so I've coordinated with a bank that will gives me and my clients access to this money at rates that are less than 3%. For some clients, it's as low as 2.1 to be able to pull money out, put it into those real estate. And so if we're making 5% over here, it only costs us 3% to access it. You can dump it into that real estate, use that income, and get. I just saw a deal come through my email from you guys for 20%, 24% cash on cash, right? So if we can be doing that and having that cycle back to kind of rinse and repeat, or potentially pump back into here, you're making money in two places at once, right?
Yep.
And I'm not a CPA, but I've talked to a dozen CPAs about this. If there's a paper trail showing that the line of credit is being used for an investment purpose, this has the potential, based on current tax law, to be an investment interest tax deduction.
An investment interest tax deduction. So for the layman's person, that means that you could deduct the interest.
Correct. Which, so for somebody who, let's say their top tier tax bracket, they're paying 37% of their taxes, that interest, that 3%, then reduces their top dollar taxable income, making the net cost to borrow that potentially sub 2% if it's a 3% interest rate, because of the tax benefits of doing that. Right.
Got it.
Yeah. And this is a lot of, for today's call, it's gonna be a lot of very high level stuff, of course. So this next drawing is gonna look pretty similar, but it's gonna be more life insurance focused. So with life insurance, and once again, this is pretty high level for this topic, but whole life. And I want to add the caveat here that not all life insurance is made equal. So permanent life insurance, like whole life, was actually designed for the wealthy and sophisticated to be able to grow and pass money on more tax efficiently or tax free. As a result, there are a bunch of levers that you can pull, push and pull to make it pretty, better or worse. It's like, for instance, I have a real estate client who came to me about 5 years ago. He had a whole life policy that was designed by someone who I think was well-intentioned, but didn't know what they were doing, where he didn't actually break even. Like, he didn't make money on that policy for 19 years. And I was like, what? Whereas typically, if it's designed properly, you can actually be making money, like having recouped any setup expenses, typically in 4 to 7 years, depending on the policy and how it's working. But a well-designed policy should be kicking off 5% year-over-year returns, net of fees, with the risk of a bank account, right? Tax-free. So if this was, we would have to be getting about a 7 to 8% taxable return to be doing what this is doing without any market risk, right? There are a few different ways to access the money in this, and something that I only know a couple other advisors doing this around the country, honestly. But the best way to do this is once you have more than 70,000 of cash values, you can set up that insurance-backed line of credit. I actually gave a talk in Florida a couple of weeks ago to about 50 advisors about these things. Because of the security of life insurance, banks, and those who don't know, banks actually, they love how safe life insurance is when done right. Typically, banks have a good 20 to 30% of their own books invested in this type of asset because of the safety. So my whole life policy, so we have, over $500,000 at this point in cash values that I can access 95% of those values currently at 3%, while it's growing at 5% linearly without any market risk. So same thing, we have the ability to use that, pump it in real estate, create that income, and then kind of rinse and repeat. The same potential tax deductibility works as well. And you guys are the first group that's hearing this, but I've been spending the last 7 months working with a $60 billion bank that's designing an insurance-backed line of credit based on my specifications that they said they're willing to go as low as 2%, depending on. So imagine having to oversimplify this. Imagine if you could go to a bank and the bank said, hey, we're going to give you a 5% account, but if you pull all the money out, we'll still give you 2% on that full balance.
So what you're saying is that, I'm just, for those of us who need to have it a little bit slower because we don't like midterms. So you can put like 100,000. Can you use real numbers? Mm-hmm. Let's say someone puts 100,000 whole life policy here. Can you just kind of run what that looks like in terms of a 5%, kick out? And then what do you mean by I can now do a line of credit and take out the 100? So the 100's not there, but I'm still making money on it. Like, that doesn't make sense, right?
Yeah.
But if I hear you correctly, that's what you're saying is I can put money in and then pull it out on a line. And now essentially the balance is virtually zero, but yet I'm still making money on the money that I drew out.
Correct. That's exactly.
Sounds too good to be true. So can you?
I get that a lot. I get that a lot.
And I know you and I've had this conversation, but I think there's probably others that are like, hey, this for a flipper, this makes a lot of sense. It's like, hey, I've got 200,000. Let me dump it in a whole life. And then let's make a little bit of money, but let me pull it out in a line and then use it, borrow against myself at 2%, right?
Yeah. And
kick it back, So, can you walk that through a little bit? Because that's pretty intriguing.
I can. I'm wondering if I don't have like a real, I can give you real numbers, but I don't have like a sheet. So here we go. So life insurance, even just like step back for a second, life insurance has a lot of parallels to real estate where there's renting versus owning. So just to give everybody kind of the basic grounding, term insurance, which I think most of us have heard of or have, term insurance is like renting, where there's a death benefit, there's protection, you're paying money. All the money goes towards renting that for a certain time period, typically 10 to 20 years. At the end of that time period, it costs more because you're older, maybe not as healthy. So the goal really is to eventually not have to have term insurance, just like the goal is with renting is to eventually become an owner. Because it tends to be the little to no upfront setup or back-end costs. It's lower on a monthly basis, but there's no equity buildup, right? Whereas with with a whole life policy, on the flip side, this is very much like real estate where, yeah, there is a death benefit. It's permanent. The part of the money in the first couple of years goes towards buying that, creating the tax shelter. But most of the money should be going towards cash value, which is money that is growing and is accessible, both tax deferred and tax free if you use it properly for whatever you want. Now, for all of you on here that are building real estate, something that is worth being aware of, and why having the death benefit makes sense, not just for the tax-free access, is, I mean, for us in Washington, both, there's a federal estate tax of 40%. There's a Washington state estate tax that gets to 20%. If we don't have a plan for how are we going to pay state estate taxes, 60% of our state could go to Uncle Sam, and he gets to have our legacy, right? I don't think anybody wants to have Uncle Sam be the one receiving our legacy benefit. But for wealth building, the cash values, like I said, this functions a lot like a Roth IRA, but without the market risk and without the age restrictions. So to answer your question, Keiko, it's a really good one. There's, with whole life, there's generally two components to a whole life policy. There's the base, and then there is the overfunding. Generally the base is the part where the first 2 years, this is where, much like, using an example of buying a house, when you go and you buy a real estate property, there's some upfront costs for the realtor, the mortgage broker, escrow, those kinds of things that are non-recurring. But if you go and try to turn it around right away, typically you're not going to get that money back until you've had it for a little bit longer, right? Using $100,000 as an example for this, I know that's supposed to be a zero. There are different companies. There are some that'll let you have access to up to 90% of that 100,000. Typically, those companies, I found they have about a 1 to 1.5% worse long-term internal rate of return. So it's like 3.5 to 4 as opposed to the 5% I was mentioning. So the company we typically use makes it so that I can use it structured so that in year one, you put in 100,000, you have access to 70,000. 30 of that went towards buying a death benefit. It's probably going to be, I mean, $2, $3, $4 million, depending on structure, size, those kinds of things. So for most people, that eliminates the need to have rental insurance, if you will, that term insurance. Generally, because this is a non-recurring expense, by year 3, you put in that $100,000 again, and it's going towards cash value. It's making money. It's growing on that 5%. And usually because of that growth that's happening, somewhere between year 5 and 6, that growth has actually paid off the costs up front. You have more money than you've put in, and it's just chugging along. So in year one, if you put in $100,000, you could get an I block on $70,000, pull that out, put it into real estate. Okay.
At about 2% roughly.
Yeah, 2 to 3%. Yep.
I mean, that's cheap money.
It's really cheap money, right?
Yeah.
Cheap money. You don't. Sorry, go for it.
All right.
I'll say it's cheap money. You now have life insurance. You never have to worry about. You have a built-in estate plan, so you don't have to think about it that hard for a while. And the longer you have it, the better it is.
So the first year you put in 100, you can get an I block for 70%, roughly 70,000.
Yep.
And when you pull out that I block, your $3 million life insurance policy still remains intact in case something happens to you.
Correct.
And that base in the first year is still cost, if you will, for 2 years.
Yep.
And approximately how much is that base? What does that cost in terms of number?
Yeah, looking at this, and it can be, I wonder if I have an Excel sheet I can show that actually gives more real numbers for.
Or just approximately, are we like 10% of 100, or like how is that?
So it's a decreasing cost that actually allows. So using those same numbers, if you put in $100,000, year one, 30,000 of that would be approximation that goes towards the cost of setting up the insurance. It buys it for you. Year 2, if you put in $100,000 again, generally of that 30, about 15 is going to go towards costs. And by year 3, it's somewhere between zero, like all the money goes to cash value, or maybe there's $1,000 to $2,000 there. So it's on a different screen and pulled it up. I have a client who we're talking through putting $100,000 a year, actually, ironically, into this. For her, I mean, she's late 30s, $100,000 a year into this policy. She would immediately have a $7 million death benefit. So if she died, $7 million to her family. The year one, 70,000 of cash value, year two, 140, year three, 230,000 of total cash value. And year four and beyond, it's chugging along at that 5% pretty much year over year, every year, because there's no longer any expenses.
So she's gonna put in $100K a year every year for 5 years.
I mean, for her, we designed it, and this gets more complicated. So having the line of credit, and this is I don't want to go too deep in here, but having this be something where you can functionally access all of it at a rate that's lower than what's growing at. Once you funded a policy for 2 years, I mean, for most of us here, and the way I use it, I use the whole life as a pass-through where I pump money into this, I pull out on a line of credit and I put it into other investments, whether it's my business or real estate. But after year two, there's enough line of credit that you could actually use this as one of the funding sources for the policy. Which, once again, I don't want to go too intense, but it's.
Oh, I see. So then you're pulling in, that's interesting. So you can actually use your own money, recycle it back into the policy, and that satisfies the growth, the base that needs to grow, right?
Yeah, and because you're using money that is cheaper than the growth in the policy, you're actually, a spread is happening. So you're still making money while you're using that money.
Oh.
Which, I mean, depending on how much leverage is being used, because I mean, the reason we like real estate is we can use cheap bank money to buy an asset that then we get all of the growth and appreciation on, right?
Yeah.
So we can actually apply that exact same concept to life insurance, but a little bit safer.
That's super cool.
Yeah.
So, Austin, I have a quick question. So there's a lot of many of us on this call, we manage hundreds of thousands of dollars to, millions of dollars, sometimes, of other people's money, to which we place into real estate deals, whether it be fix and flip, maybe a syndication. So
yeah,
my idea was like, is there a way, instead of storing private investor capital in a bank account where it's not making any money, it's just holding there for us to use, and sometimes it's necessary because we need the money liquid, right? We need to move it from the bank account to pay our guys, or if, like, let's say you're flipping a house, and then after the project's done, profits come in and it goes back into the bank account after all distributions are made, right?
Yeah.
Is there a way, since you can put it in a life insurance policy, but then borrow against it, right? With the iBlock, is there a way we can, instead of putting it into a bank like Wells Fargo or something, that we create a life insurance policy? Is it possible to store money there, even though it's private capital, and it's liquid enough where we can pull out, borrow against it at the 3%, so we're making a spread of possibly 2%, and when you pay it back, are you paying the interest back to your own policy? So you're actually paying interest to yourself. So it's, when you pay it back, the 3% you're paying for the iBlock is being put in on top of your cash value. Is that right?
So it's not going on top of it. So what's happening is when you use a line of credit, like, you're not creating. So on a clarification. So with a 401k loan, which is kind of how this works, when you're talking about, they take the money out of the 401k, give it to you, and then when you pay interest, you're paying it back to yourself. With the life insurance, the power in it is that your money never moves out of a place where it's growing. So the entire time it's in the policy, it's growing. You're getting a loan from a bank. The bank is saying, we'll give a line of credit on this for this amount. So technically you're paying back the bank at that 3%, but the entire time your money has been making money in the background. You've never pulled your money out. And to your question, Corey, actually, I have a mortgage broker that's real estate focused that we're doing this exact same thing. He created a policy. He can put $500,000 a year into it. We got a line of credit on it for him. And then, so when investors coordinate with him to hold the money, for a little bit. He does, and then whenever they want it back, he gives them the money back to the line of credit, and he's getting the spread, that the extra 2 to 3%, just for being a place to be able to hold money and pull it in and out.
That's super cool. I love it. Anybody else got any questions? I feel like I'm hogging up everything.
It's already 1 o'clock, and I feel like we've scratched the surface of this conversation.
Joshua is asking if crypto is considered a security for the S block.
I know I have some clients who have found ways to get to their crypto, but most banks, unless they're like a crypto specific kind of bank, won't do that because of the volatility around it. Like there's the concern of what if this loses 80% in a day and suddenly they're at a negative collateral position. Yeah. So most of the time that's not the case.
Usually not a good idea. Blaze made a comment, which is kind of interesting. So a lot of times as real estate investors, we do get investors who come to us and give us their money, $100,000, $200,000, $400,000. Could somebody, is there any legal, ethical problems with putting some of that money into a whole life policy? What's the advantages of that, downsides of that?
The legal, ethical, there's no issues there. The one thing is when we apply for a policy, there has to be an insurable interest. The insurance company has to say, okay, who's benefiting from this? Why is this policy being put in place? Right. So that's where, if we could justify, hey, I'm a business owner, the beneficiary is my business or these clients or anything that we can justify that there's a reasonable reason to have this protection in place, then we can use this to create that asset that holds the money.
Yeah.
Yeah.
Which is actually kind of an interesting concept because sometimes investors will come in, give us a chunk of money, and we put it right into a real estate project. But if you first dump it into the whole life and then funnel it through like you're doing with your your cash checking kind of a thing, then we're able to actually pick up additional value, right?
Yeah.
So it's kind of an interesting thing to do. Okay.
Yeah.
Cool. What other questions? Are you able to get the money out of the whole life policy in the event you want to cancel it? Any fees associated with that?
Yeah, it's there are no surrender charges for it, so it's you can absolutely cancel it whenever you want to. Certainly, any fees associated with setup that went towards kind of buying the life insurance that would have paid out while you had the policy, you can't recoup. But if 7 years in you said, I've put in $500,000, I have $700,000 in here, you can get all of that. The one thing to aware of is if you were to cancel, anything above your cost basis, so what you've put in, would no longer be tax-free because essentially you've canceled the tax shelter. The other thing though, going back to what we mentioned before about if we have the ability to no longer have you funded at all, if somebody can fund 2 years, if in year 3 they say, I can't cash flow this anymore, they don't need to anymore. It can become an asset where we're leveraging it to fund itself. And honestly, it turns the life insurance from being an asset that's growing at 5% to sometimes in the high teens, low 20s, depending on how we utilize it. Because you're getting a pretty massive ROE, right? Because you're essentially not putting any more of your money into it, but it's still growing for you.
So ROE is return on equity?
Yes. Yep.
Right. And so if you're funding it for a couple of years, basically it can take on a life of its own. And then you're saying, what I just heard you say is that it takes on a life of its own and could actually return more than 10%.
Yes.
Annually.
Yes.
So why would people not want to do that?
That's a great question that I don't like. I think the main reason people don't do it is there's a little bit of complexity. It's like I said, I only know a couple advisors around the country that use iBlock strategically, and I don't know any that use it specifically for real estate investing. It creates a little bit of you have to have a little bit of an idea of how do lines of credit work? How does life insurance work? So it takes two complex ideas and merges them together. But if somebody's willing to be educated around it, like I honestly, having done a ton of research on interest rates since 1920s and how life insurance works, it takes the life insurance from being the risk of cash to really being the risk of bond, because there's a little bit of interest sensitivity there, but very, very, very minimal. And it really can, Like it's leverage that I would say is very similar to real estate. It doesn't have the same upside potential as real estate, which, of course, if you rehab it and those kinds of things, you can't rehab a whole life policy. but it does have, I'd say it's a little bit safer from a lending risk because the asset doesn't lose value. It's backed by, some partially contractually guaranteed returns, and it's fully liquid.
That's cool. And so you're also saying that, if I've got $250,000 in my whole life, that when I go apply for a loan for a mortgage, they'll take that whole life and consider that an asset, right? And that's a strong asset on my balance sheet. So that's cool. John's asking a good follow-up question here. So what about the shady companies? Because, you see whole life offered online, you see it on the back of buses, so how do you differentiate, or what are some of the key words to look out for that would help us to say, hey, these are not the right places to go?
Yeah. Well, I would say the easiest way to solve that problem would be to have me and my team help with that. But in terms of shady, honestly, there's, that goes back to when I was mentioned before, I had a client who had a policy that didn't break even for 19 years. It's all in the structure. So when I was talking about base and overfunding, people who either are commission hungry, like they want to make a bunch of money, or they don't know how the policy works, they can make the base be all of it. Meaning you don't have any cash value growth for 3 to 4 years. And as you can imagine, if you spend the first 3 years only paying expenses, it doesn't become an asset for a long time. So having somebody who knows how to structure it. So like the fact that I use this personally, I structure my own policies. We have probably 700-800 clients that most of which are using these for real estate or business kinds of stuff. And we're also independent, meaning we have access to pretty much every single company in the country. Like I can come in and say, hey, this is the best company. Here's why, here's their track record, and here's how we should structure it. Right?
That's good. Yeah, no, Austin's the real deal. He's my personal go-to for all of these financial wizard guru type things. So Austin, will you do us a favor real quick? Drop your email address in there.
Yeah.
Just because there's going to be lots more questions. I'm going to let Corey ask his questions now. He's been biting his tongue for a little bit since I've taken over.
Thanks. Austin, sorry, I cut out right when you're answering my question last time. So I still haven't got to, but from what I got.
We'll have to connect later, Corey, just you and me. That's totally fine.
Then we can relay to the group, how.
I'm going to have a little jealousy if you guys, connect without me, but I'll make it work.
Well,
but no, Corey, you got some good questions that you should ask, because I think it's beneficial to the real estate investor perspective.
Yeah. So from what I understand, your answer was yes, we could do that. Is that correct? We could.
Yes.
Yeah.
As long as there's an insurable interest for doing it, you can set it up. Yeah.
Okay.
And for you guys, for instance, just as an example, if you guys, so we're like, what, Corey and KCOA are their key people for KCOA Capital, right? And then you could potentially have a business owned policy on you guys that would pay out to the business something happened, which if that happened, then the business could then pay off the investors because it has this massive death benefit. And in the meantime, you have an asset that's growing as a business asset that you can pull in and out. And there are, depending on the size, there are some actual unique what's called rider in a policy where you can actually have early access to cash values if it's a business owned policy that's in general more than 150,000 or so a year of premium. So there are ways to actually make it so that you have access to almost all of it and are creating an asset. So it's which isn't true for somebody who wants to put $20,000-$30,000 a year into it, but in so there are specific scenarios that are better than others. Right?
Is there size limits? Let's say, you know what, why don't I just ask this question? We just talk out loud, because then we'll get into the details later, but that way maybe we can understand the framework and everybody can understand where I'm getting at with this idea is we're going to be managing, let's say it's a few $1 million, let's say $10 million. Could we just right away dump that into a policy, or does that have to bleed through? It has to mature or season, or is there any of those stipulations with this type of policy?
Hang on really quick. Sorry, guys. My kids didn't try to interrupt. Just
no worries. Go for it. Daddy duty.
He's got 4 kids, so he's got daddy duty. No,
Yeah.
these are great. These are great questions. Anybody who got more questions, dump them in the chat there. And Corey,
Guys,
maybe
this
after
could be a game changer. I'm telling you. I've been trying to Kiko and I've been talking this through. So, I mean, this could change a lot for everybody on the call, because if we can figure this out, then our cost of capital will go down dramatically, to which we can pass along those savings to everyone on the call. Money will become really cheap then if we can pull this off. So Austin, let's say we have $10 million, right? And that's we're bringing that into the policy. We have to pull on it immediately, so we can borrow against it up to what percentage of that cash value?
You can borrow up to, I mean, there's some companies that will do 100% of cash value, but if you do 100%, you have to pay the interest out of pocket. And typically the companies that have the lowest interest rates will give access up to 95% of cash value. Okay. For them, that extra 5% buffer just gives a little bit of safety.
Right. Yeah.
The other thing about just dumping money in, so the tough part with just, so the IRS made rules a long time ago about how much money can be put into a policy before they take away the tax-free access. Because you can imagine 100 years ago, you have the Rockefellers and those kinds of people saying, I'm going to make a $1,000 death benefit and dump $1 million into this and call it tax-free.
Right.
Of course, the IRS is like, nah, it's not a thing. So they have these thing called MEC limits, or modified endowment, which is just essentially where they say for a certain death benefit size, you can put in X amount before we make it taxable versus tax-free. So generally, you want to design it so that you are funding for a few years, so that you can maintain the policy as a tax-free asset.
Got it. Okay. And a few years, like 3 years, it has to stay in there without you pulling it, or?
It doesn't have to stay in there, but we want to manage cash flow so that, like, with this insurance-backed line of credit, I typically tell clients, if you can fund a policy for at least 2 years, the rest of the years become optional because the line of credit could fund itself. But in year one, I mean, you could access the money right away in year one if you wanted to. And the only stipulations on the IBlock is most banks will tell you have to have at least 70,000 of cash value to be able to pull it. So as long as a policy has more than 70,000 of cash value, you can set up a line of credit and you can pull it out. Otherwise, you would have to use what's called a policy loan, which is a loan from the insurance company, which typically is more of a wash loan. So it's a loan where if they're paying you 5%, they're going to charge you 5%, whereas the line of credit is an arbitrage rate.
Right. Got it. Okay. Now let's say we put the 10 million in, we don't want to wait because it needs to be liquid. So we borrow against it immediately. That's possible.
Yeah.
Okay. So we put 10 in, we pull 9 out. Is that possible? Because that's 90%, or is that too high?
It depends on how you structure. So if it's a business owned policy where we can get some kind of special riders, then yes, I'd say most of the time, if it's a personally owned policy, we want to assume that, so I guess, so not to get too nitty gritty here. So the two best companies in this space, a company called Penn Mutual, another company called Mass Mutual. Yeah, Mass Mutual has a policy that they'll do what's called a high early cash value. So they'll give you access to up to 90% of your contributions in year one. But the trade-off is that the long-term internal rate of return, so the actual growth on it, is about 1.5% worse than the Penn Mutual policy that you can only have access to about 70% upfront.
Got it. Okay.
It's a trade-off. It's if you can give up a tiny bit up front, you can then acquire a policy that's going to be a lot better. If we had the same conversation next year, it might be different, because I've actually been in talks with the CEO of Penn Mutual about creating a high early cash value version on their platform for this specific reason. So
you're in talks with some of the principals there that can make some moves to craft a product for like something that people like us on this call could utilize.
Correct.
Yeah. Oh my gosh. Okay. Yeah. I'd love to meet up with you. If I got to fly up there to Everett, or you're in Everett?
I'm in Redmond. Yeah.
Redmond. Okay. Yeah. Let's do this, because this is my thoughts. Let's say we put 10 million in, right? We pull 7 million out. we're at 70%. We're that it's still that 10 million is still earning roughly around 5%. Is that correct?
The part that's cash value. So there's part of it that goes towards the costs
Okay.
of buying the death benefit, right?
And how much of that goes to the cost?
Yeah.
Would you say?
So that's where
it matters your age, it matters your
age, matters how you structure it, those kinds of things. So it's I mean, if we wanted to fund a policy where we only funded it for 5 years, I could probably make it so you have access to 85% of the total contributions upfront.
Okay.
But one of the things that, since doing all the research on the line of credit, I've started expanding the funding period, which means a higher death benefit. It means a little bit higher costs upfront, not dramatically. But imagine this, right? Imagine if we had a bank that the bank said, we're going to give you this 3% account that will let you trade for the 5% account as often as you want to, right? And in that situation, you would want to take advantage of that trade for as long as possible and for as much as possible, right? So it's changed a little bit how I structure the life insurance policies, because if we can fund a policy for 15 years and use the line of credit to trade 3% for 5 over and over and over again,
right?
It can be a pretty cool tool.
Okay. Because I put myself in some of our investors' position, right?
Yeah.
And I'm thinking, all right, if an investor approached me for private money and they want to pay me, or they're offering to pay me 12%. And I'm like, all right, I got some cash, I want to invest with you. But then they say, hold on, I'm going to take your, let's say, $100,000, and I'm not going to put it in my Wells Fargo account. I'm going to put it in a life insurance policy, and then use it from there. And for me, I would see that actually as a very smart move, and if anything, I feel safer. Why? Because I'm assuming that the beneficiary is either the individual or perhaps the entity that you're investing in. So if something were to happen to that investor who's managing my money, and if that person dies or is incapacitated, is sick and can't do anything, I'm kind of exposed, right? Because nothing's going to move. My money's stuck in his account, or it might have been used already. So whereas if he puts it in a life insurance policy, that's liquid. If he's accruing interest on that money, he's healthier, in my opinion. So I would feel more comfortable just with that alone. Now, two, if there is, in the worst case scenario, if the beneficiary is the entity or something, and something happens to him, then there's some sort of recourse or security for my money.
Yeah.
Hopefully. Is that, am I thinking this through, like, am I along the right lines? Or
I'd say, those are absolutely correct. Yeah. Because it creates a death benefit. So that just if you're the one, right, and you put it into a policy, if you pass away, there's this big payout that will then be able to allow the business to make the investors whole, right? The longer you have it in that policy, so one, it's managed by a company that's been around for over 100 years, that's doing good stuff, that has the money. And part of the growth is contractually guaranteed. Depending on the state, sometimes that money is even credited or protected as well. So there's some liability benefits there too. And yeah, you have the benefit of, by cycling it through that over time, you're creating a spread, which means that your business is going to be having this natural pool of money that's giving you more liquidity and flexibility to have protection against the unknowns. Right.
Right. Yeah. So if anything, as an investor or a private lender, I would feel more comfortable if somebody was structuring their finances that way. So, and if we can't do that, that also cuts our costs kind of maybe close to half.
Over time, absolutely. Yeah.
Right. Okay. So, because if I'm paying my investor 12%, and I use their funds, it's possibly accruing at 5%. So now I'm negative 7% roughly. And then I would borrow against it at roughly 3%, right?
3%, which is potentially tax deductible. And the larger the amount, the kind of the deeper the discount. So it's
okay.
Yeah.
So basically my answers to what I'm thinking is there is a possibility that we can make this work. And if not, then you have the relationships with the people to maybe have a sit down to help craft a product that can fit our needs, everyone on this call's needs.
Yeah, I mean, assuming everybody's healthy, like there are so many different ways to structure it. Like I mean, for us, I mean, working with real estate investors, I structure it so the costs are as low as possible. So there's as much cash value because we want to be using that as a wealth. Like we want it to become your own bank, your own tax-free bank, ideally, right? Now, like I said, I mean, from a range perspective, like I have clients who put 500,000 plus a year, sometimes more than that. I have clients that put $30,000 a year into these policies. And I mean, I have some that even do less than that. But the tough part about doing less than that is it takes a long time to be able to use an iBlock if you're not getting to 70,000 for 5-6 years, right? But yeah, there's so many ways to do it, and you don't have to have a ton of money to be able to do it. And like I said, if an investor can, comfortably commit to, I know that I can fund this for at least 2 years. After that, it becomes a flexible funding because you can either have the policy fund itself, or you could continue to treat it as a pass through, where you put the money in and pull it out for investments, which is
got it. Yeah. Oh, that's awesome. Okay. I would love to keep this conversation going, Austin. I can't believe, I wish we had more. I could talk forever on this strategy because I see this as a huge advantage for everybody on the call. If we can take the time and we have the patience to structure a policy like this and learn how to manage the money, it'll cut our costs down. And on our lending business, if anything, it'll cut our costs down so much that we could share that to all of our clients to bring their costs substantially down to a point where, not only are we competing with some of the largest institutions in the nation in the private lending space, but we can basically price way lower than them because we have the extra 5% or even 2% spread because we're borrowing. And when we're paying back basically on top of our policy. So we're growing the account while also earning profits and cutting our costs down. So it's benefits from 3 angles. So I don't know if everyone else can grasp that on the call. I hope so. If not, I'd like to have maybe another follow-up call where you come back on maybe in a month or so after we kind of talk this through a little bit more, and then open that up to the group to see how they can utilize this in their ventures and their business. I think it's a smart move. And you're right. Like a lot of this type of policy, it has been around for a long time and people utilize it to grow their wealth. And it's one of the most powerful wealth building vehicles that I've seen. So thank you for sharing, Austin. And everyone, thank you, Pete, for answering the questions in the chat, because there's a lot of questions, a lot of great questions in there, and he's been answering. So please check out the chat, guys, before you log off. There's a lot of great info in there. And is there a way to download the chat? Because I'd like to go through it too and see some of the questions and the answers in there.
That's
interesting. Does anybody know?
Yep, I can go ahead and share it with you, Corey.
Okay, perfect. Thank you, Sheena. Okay, cool. You want to take us out?
Sheena's always on it.
Thank you so much, Austin and Pete, for
Yeah. So anybody who wants to reach out to Austin, his email address was there earlier. Their team is available, and we don't bring guests on just to promote, but we bring guests on because we use their services, we believe in them, and just like everybody on this call, it's a family, and we try to do things to help each other grow our own businesses. And if we can cross-pollinate and help each other grow, then that's even better. So Austin and his team are part of our family, and so we're excited to just refer folks to them. We get nothing of a benefit for that except for his smiling face when he calls. So that's awesome. Austin, thanks. Pete, thanks as well for just kind of sharing all that you have. But obviously, there's so much more you could talk about. Probably the best is that anybody's got questions. every scenario is a little bit individual and independent. And so reach out to these guys and they'll be able to kind of tailor something if you're interested in that. But yeah, we're definitely going to have a big conversation with you, Austin. We might have to fly you down to a meeting.
Yeah, deal. Yeah. If you want to take me to Hawaii in the middle of Seattle winter, yeah, that's totally fine.
Yeah. Yeah.
And
You gotta bring the kids.
To add to what you said, I mean, it's like today almost turned into like a life insurance conversation. Of course, that like it works really well with real estate, but that's just one part of a really good financial plan, which we briefly touched on, like lines of credit, stuff like that. But we do, so that everybody knows, life insurance is just one piece of what we do on a more holistic level. Right?
Yeah. And guys, I just want to echo that, because before our call, we were kind of exchanging emails, going over different topics, because there's so many different strategies that Austin can help you with that just makes sense. And I don't see a lot of people in our space utilizing this, meaning we're leaving money on the table, and leaving opportunity on the table. So let's dive into this and this, let's educate ourselves and educate each other. So Austin, we're going to be working, I think, a little closer with Austin, even more so on our business and how do we utilize some of these strategies for our business. So thank you so much again, Austin. Let's keep the conversation going. And maybe if you have time, we can bring you back regularly to talk about the next one, right? Like the S block, right? Like that one actually sounds very interesting to me too. So there's so much to learn, and whether you wanted to be or not, as real estate investors, we manage a lot of money, we manage a lot of assets, and it's a big responsibility, right? So, to serve our investors, we always have to manage risk and return, right? And if there's strategies out there that like Austin and his team can help you with, then I think it's our duty to at least explore it, try to understand it. And if it works and makes sense, then execute and utilize it, right? So, Austin, do you have any final words for the group before we head out for the weekend?
Yeah, I'd say one thing with holidays coming up and those kinds of things, give a little bit of extra time for following up, stuff like that. Would love to talk to all of you, any of you that want to have these conversations, but also I don't want to have you guys email me and have it be 48 hours later you haven't heard anything. So we will get back. We're expanding our team. As you can imagine, these topics and these things, I mean, we're getting 3, 4, 5, 6, clients a week just kind of naturally without coming on these things. But so that's why we added Pete, why we're adding another advisor, another staff next year to be able to continue to support people that are doing all the cool stuff like you guys are doing. Very much look forward to having a conversation with any of you guys that want to know how to apply these concepts.
Well, we definitely are thankful for you. Thanks for the time, and definitely encourage everybody who doesn't have really a plan in place. You don't have a solid life insurance policy and you're married and got kids. It's time. We work hard in real estate because we're building something to pass on. So this is a good opportunity to make sure that happens. So hit Austin up. So with that, we'll wrap up. Of course, we're going to hang out here for a bit. Austin, if you got to go, great. If not, in case anybody's got any final words, but we'll kind of sign off in terms of recording. But thanks everybody for joining the coffee talk this week, and we'll catch everybody next. Well, I don't know. Are we doing next week, Corey? It's Thanksgiving. Corey's gone. He's already left us. Well, we'll let everybody know if we actually do next week or not. I'm gonna guess we don't, but we'll see what happens. But we'll let everybody know. But yeah, thanks everybody.
Yeah,
for jumping in.
Happy Thanksgiving, everybody. We'll talk to you later.
Appreciate it. And, take care. The recording, Lisa, is